Good morning. Welcome to this supplementary. We've called it a 4-week training intensive, the 4-week process and mindset training intensive that Dave and I did last year. Well, this is a supplementary session to that, is probably the best way to position it. And I'm going to end up talking about how to trade properly. And I'll certainly give you the source of that, because in Mark Douglas's book, Trading in the Zone, he doesn't talk openly or much about trading properly, but he did in his Pathway to Consistency workshop. So that's where that term comes from. So we will get into that. Before we get into that, we are going to just have to put up what we normally do and tell you everything we cover here today is a general investment advice, not specific or personal investment advice. So the agenda, 3 main points, 3 main sections, if you like, in this session. And it's going to get quite heavy, but firstly, I'm going to start off with the response to the forum, the performance thread that is on the forum. About 3 weeks ago, maybe a bit less, there was a final posting there. And what I said is that I would respond to that in a webinar. So that's this webinar. But I'm going to do it in a way, and then I'll talk a bit about the performance thread in a moment. But then the second section is I'm going to talk about how to prove the future. More about that when we get there. And then we're going to finish up with responding to that, how to trade properly. And I'll make no excuses about it or apologies about it, but the material is mainly Mark Douglas. And I've repositioned it and put it into slightly different terms and come at it from different angles, if you like, using research as a foundation and also not only the last post that is on the forum, but the whole forum, that whole thread on that forum that's been going for about 3.5 years as a basis and input into the session, which we can use to learn from, both myself and hopefully all of you that watch the recording or are here now live with us. So let's talk a little bit about the performance thread on the forum. I'm going to use the last post as a coaching session, but not only just the last post. I'll pull some specific stuff out of the last post, but it really is generic stuff. It's generic issues and problems, risks, if you like, pains, and the word is used in that last post that typically traders will encounter and feel and think in this journey, this wonderful journey that we call active investing or trading the financial market. So this whole thread embodies the crux of the problems and the issues that traders have to overcome. And I'm going to give you a solution. We're going to pull some of that apart. And I don't do this personally, so this shouldn't be taken personally by anybody that did post on the forum and raise questions and make comments. I'm just really using those comments as a basis and a foundation to provide answers that every single one of us go through to some degree as traders in the financial markets, because they will always test us and take us to those limits, those thresholds where we will think and feel the same things as what are discussed on the forum to some degree. And it's that degree that we have to keep working on. We have to minimize it and make it less and less as we tread this path of active investing. But I should also make the point, and I would like to make the point that anybody's opinion, comment, question, if you like. Question's good. It's always better to ask a question than make a statement, and something I work on in my own life. But anything that we comment or make a statement or have an opinion about is limited by our current knowledge and skill that we have. And at that particular time, it's our truth. It's a trader's truth. And our truth will always be a subset of the universal truth. And Mark Douglas talks a lot about this until we find a new truth. And that new truth we become aware of it, and it's like a light bulb going off when our knowledge and our skills shift, hopefully for the positive. And the example that Mark talks about in Trading in the Zone at length is the one of being bitten by a dog, where that boy's truth changes. But until then, his truth is that all dogs are dangerous. And we have that same, that's why I use the example, is we all experience that up to where we are in our current journey in this caper we call trading the financial markets, until we get a new truth. And that gets opened up, if you like. Our eyes get opened up when we gain new knowledge and particularly gain new skill. And skill obviously comes with action And that's an experiential skill that we have to get through practicing. So I'm going to be responding as if answering the repeated similar comments and questions that have been asked, not only in this thread, but for many years. We've changed our forum many years, but we used to get hundreds, if not even thousands of comments, going back to when we first released SPA3, what's now SPA3 Trader, back in October of 1998, as people struggled with this. And I certainly gave answers to those, but and as I was evolving and understanding this 1999, 2000, but when I met Mark Douglas and went through the trading in the zone and had the privilege of being mentored by him for so many years, this has become clearer and clearer and clearer to me. And I'm going to try and in this one session give on the back of the 4-week training intensive, but also the material in trading in the zone and atomic habits, try and bring this down into one session and position the answers and then give the answers. And now some of this, people who have done the 4-week training intensive, this will make perfect sense to them. It'll be a reminder, and as we all do, and it'll be on their path. They'll be going, okay, good, this confirms what I've learned so far. For those of you that are hearing this for the first time, it may go over your heads, but that does not mean that you don't have to learn it. What it means is that you do have to learn it. And so I'm going to be quite punchy in some of the sessions, in some of the sections, and some of the slides I'll go through today. Right, let's get into the forum post. And I've rather than typing stuff up, I've used screenshots here. So Nick makes the point, and this is the last forum, and it's got 18 days. It's probably about 21 days, 3 weeks ago now. As I intimated earlier, the pure quantum transactions generally 161 now, along with the win rate down in the 35 to 40% range, is not really the journey I want to be on, especially with a Kirker 6% compounded annual growth return. So I guess with the sporting analogy, the football coach is the bloke in the team that wants to play basketball. Okay, now I just want to show you this particular equity curve, which is Nick's journey. And the gray line is his portfolio equity curve, and the red line is the ASX 200 accumulation index. And the whole time, bar just the beginning, he was slightly underperforming. He added some cash and has since outperformed and been above. And it really has been mainly due to the exits that occurred in the system, which you shouldn't assume you would have taken those exits if you hadn't been following a mechanical process, put him ahead. And now just at the very end over here, he is struggling and has disappointment with the fact that he's dropped below the accumulation index for the first time in nearly 5 years, in 4.7 years, as it turns out to be. So people struggle with this, right? And we get underperformance of the edge against the market, but you also do get outperformance at times. And we tend to, depending on what notion it is that we're trying to prove through our ego or whatever, is we will hone in on the things that prove our notion, and we'll exclude, it's called a lock-on, lock-out, a low-low. We'll exclude the things that disprove our notion. So I just want to make that point over here, that this has created disappointment, even though to me, that is a great equity curve. And the point I make here is that mechanical systems, not only SPA3 investors, seem to be held to a higher standard when over the long term, managed funds, plenty of other funds where you could put your money, financial planners are all below the index, super funds, both balanced and all share type super funds, all end up below the, or close to, but below the long-term averages of the accumulation index or total return index. So, but this is being held to a higher standard. This performance that's above the red line over here. So the point, and I'll address this right at the beginning. The football coach is the bloke in the team that wants to play basketball. Well, as an investing coach, that's me, football coach in this analogy. Perhaps something else altogether should be played, not changing to a different sporting code, but just get out of sport altogether and become passive, become a spectator. However, passive investing, as life is an infinite game, as is active investing. It's still an infinite game that is not problem-free. So if you change sporting codes, or even if you become a spectator, it doesn't solve the problems in the environment in which we're operating. Ultimately, losing and winning as an investor are both measured in the same way, whether you're passive or active. Risk number one, we have to have enough when we retire, when we want a nest egg and we're no longer earning an income and we now need to live off our nest egg. Big risk number one. Second risk is sequence of returns risk. How do we solve, by becoming passive, we don't solve the 50 to 80% drawdowns that are going to occur at some stage in the future. So carrying on, after using the system for at least 5 years, which is not quite, it's not at least, it's 4.7 years. it doesn't win often enough for me, and the win sizes aren't really big enough to offset regular losses of 9% plus, which is just not true. And as I'll show you in a moment, with lots of transactions come lots of brokerage and friction slippage. You can buy, sell at the wrong part of the session, and your compounded annual growth return is negatively affected, which are all emotional comments, because they're not based on how you should be thinking as a trader, but certainly not on statistics. Now, sure, I'm not having a go at Nick here, like he isn't having a go at us at Sharewell Systems, but I'm using this as an example because I've seen this, for 25 years, and it comes from people who haven't yet grasped the material, that is in Mark Douglas's book, Trading in the Zone, which obviously we pulled apart and unpacked in the 4-week training intensive. And this is where you so let's just address those particular points. So the point I want to make is that in the portfolio of the equity curve I just showed you, that had a 39.4% win rate with a 1.98 payoff ratio. So that means that the average winner is 2 times bigger than the average loser. So the point of the makeover here is the win sizes aren't really big enough to offset regular losses of 9 plus of around about 9%, which is just not true, because the average winner is twice the size of the average loser. But the mindset that people get when they're looking to justify a notion is they don't see that. They don't see the statistics in front of them. And they exclude even worse statistics that they get of other portfolios they might have, and they accept those. So now, a point that I want to make is that this particular portfolio had a win rate of 70%. That was the peak it achieved after the first 30 trades. And for the life of the portfolio, three quarters of the time of the life of the portfolio, the win rate was greater than 40%, with a maximum drawdown of minus 19%. Yet the perception anecdotally through a feel is that the win rate is down in the 35 to 40% range, despite it just having fallen below, and most of the time it was above 40% and peaked at 70%. So it's a misrepresentation based on feelings rather than anecdotal feelings, rather than actually looking and pulling apart what the truth is. So, but however, that is that person's truth. This person also had another portfolio, which when he stopped after 117 trades, had a 44.4% win rate and a 1.88 payoff ratio, which means that the average winner is 1.88 times than the average loser, and had a maximum drawdown after those 117 trades of minus 13%. But there are 2 other systems being used. Perhaps you have as well, maybe subjective portfolios that don't get scrutinized. We have lots of customers that come and join us, and there's countless that I can remember over the years who've been using some other system but have never really analyzed the data like I'm looking at over now, but have a feeling, a perception that it's actually doing all right, but haven't actually, when they go and look at the numbers, it's not doing all right. So the other systems being used have a win rate of 37.31% and a payoff ratio of 0.98, meaning that the average loser is bigger than the average winner. That's what 0.98 means. Anything below 1 means your average loser is bigger than your average winner. That's after 43 trades. It's currently in 37% drawdown and losing money, and had a maximum drawdown of minus 40%. And there's another system which has a win rate of 33.3% as a snapshot. Also has a profit ratio of less than 1, meaning the average loss rate is bigger than the average win rate. Also losing money 20%, and has a maximum drawdown of minus 28%. But this person is continuing to trade those systems. Systems are put in inverted commas. And so at what point do you look at the statistics to prove or disprove your notion that you have, which is emotional and anecdotal? Well, we'll answer that question in a moment. Another point to make, which is also, now the reason I raise this is because over the years, we have seen this so many times, not only with new customers or even existing customers that continue to remain customers for the long term. We've got many customers that have been with us for more than 20 years now. I've had all these discussions with these people. They've shown me their data, so I know it. So I'm exemplifying this as a typical stage that any trader will go through in the financial markets. And we've got to try and remove that subjectivity, not from our analysis to decide what to buy and when to buy and how much to buy and when to sell, but also from analyzing our performance as well. We've got to get rid of that subjectivity as best as we possibly can, which takes work and effort. So this is typical. This is not just this particular person. This is typical of what I've seen so many times from customers that have been on this journey for a long time, a medium time, and are relatively new to it. So hopefully we can all learn from it, including myself. So the other point is made that brokerage now totals around 4% of capital amount. So I want to make a point that the size of the brokerage that you pay is also a function, and the main function, of the capital that you have invested. The smaller the portfolio have, the larger the amount the brokerage is going to be as a percentage of your total of how much you have invested. But you should actually look at brokerage not as the amount of money you have invested, the capital you've invested, but of the capital risked. And so I've done the calculation in this particular portfolio. And the capital risks is taking the same amount of capital as an active investor and reinvesting the same capital over and over and over and over and over again. And that is capital risk. And that's one of the beauties of being active opposed to passive, is if you've got $100,000 and you passive, you only invest that $100,000 once. And then whatever strategy you use for that buy and hold, in equity, an index ETF, whatever it is, that's that 100,000 invested only once. Whereas if you turn your capital over, obviously there's a balance between doing it too much or too little, then you're getting to use the same capital and risking it over and over again, which obviously you've got to pay some brokerage for. By contrast, the ASX public portfolio is its total amount of brokerage as represented or as measured against the capital risk is at 0.12%. So that is less than half, or about half, of this particular portfolio, and that also is a function of how much capital is invested in the portfolio. Right, keeping on going. So the benefit of the system, as I see it, is solely reduced drawdown versus the index ETF wait and win approach that I don't hear too much about anymore. So let's just make a point about that. The wait and win strategy that's being referred to here is basically buying and holding IJH. The IJH, that is Indigo Juliet Hotel, is the S&P 400 index, which can be bought and held here in Australia or in the United States. And but that's well and truly there. We have staff members using it. I know that there are many customers that use it, and they've put their kids into it. So sure, we don't talk about it very much because you don't trade it. It's there. It's in the documentation. But maybe we should give updates on it in the weekly wrap, and I'll talk to Dave about doing that. The other point that says here is that, but this risk can be managed through alternative systems that have fewer pain points and which don't involve specific risk and selection bias. Now, when I read that, immediately that is saying to me that this particular person, and we see this all the time, again, I'm just using this as an example for coaching purposes, is that these are automatic pain avoidance mechanisms at place. We are honing in on specific areas that we are feeling pain in, and we feel from time to time. But what we are doing is we don't know what we don't know about any other strategy that, if you move to it, will also have pain points. So you can't remove the pain. There is going to be other strategies will have pain points too, just different pain points. That's all it is. And you have to be able to be objective about understanding and looking into what the other strategies, or another way of how you do this. For instance, passive investing, buying and holding an index ETF. What pain points will you experience there in the future? You may not get them regularly, but there could be one massive big pain point that just gazumps all the other minor pain points that you might feel along the way of an active investing journey. So this is what you have to think through, rather than just anecdotally, off the cuff, impulsively just say or just decide or react to what's happening in this particular moment in your investing journey. This is discussed. Pain avoidance mechanisms at play are discussed in detail in the 4-week training intensive. I will remain with my monthly systems. I don't even look at them until the last trading day of the month. So for me, that appears to be the way forward. Otherwise, I will remain in the trading wilderness trying to adapt to systems that don't suit me. Question: does the system have to adapt to us, or do we have to adapt to the system? Well, it's probably a bit of both. But somewhere along the line, we have to adapt to the market. We have to adapt to a system to some degree, and we also have to adapt to ourselves too. We can't just stay as we are and have a fixed mindset, as Carol Dweck talks about, a fixed way of thinking. We have to have what she calls a growth mindset. And a growth mindset means that we do have to change, and we have to. The tough bit there is recognizing, what can we change in the process and the system, and what do we have to change in ourselves so they come together. But just to go and find a system that suits me well, you're gonna be in the wilderness forever until you also do some changing too. So if we have an unskilled trading mindset and can't trade properly, what system will suit us? And this is one of the whole cruxes of Mark Douglas's book is that we have to learn how to trade properly first, i.e. trade consistently and objectively before we can trade any system. So, and that is, if you don't get that out of the book, then, keep going, keep studying, keep learning, because that is what we have to do. We have to learn how to trade properly first. We have to acquire and attain the necessary mindset skills that are conducive to being a consistently successful trader. And that's what the whole book is about. So, we have to learn how to trade properly as well. And otherwise, you're never going to find a system that suits us. And more points over here, just reading from the green arrow. My US monthly system is plus 20%. It's not like you have to miss out on returns by being less active. Well, that's just a misnomer and just not true, right? Because if you're adopting a monthly system and October 87 happens, or October, November 2008 happens, or even March 2020 and the COVID crash happens, well, then you are going to miss out on big returns. The big assumption is that you'll be able to mentally withstand the pain experience when falls like this happen again. So this is just a transfer of problem. The problem that's perceived here of being active is going to be solved by becoming less active. Well, sure, you're going to overcome the pain points of less activity, but all you're going to do is transfer those pain points to another system, which actually is going to create bigger pain when the falls happen. Let's have a look at them. So all I've just said there is the pain of activity is shifted to a different pain to solve. So here are this is October 1987. The all ordinaries fell 41% in the month. So I've basically taken the first day of the month to the last day of the month. That's a 41% fall. So if you had changed or changed whatever the monthly strategy is to change from one set of stocks to another over there, well, you got to hold out the month. Big pain there. And of course, it went a bit further. This here is October, November 2008. There we had a 17.8% fall. I'm just taking the month boundaries. It actually went deeper during the month and then recovered a bit. Here's another one. This is November, which was a 13.28% fall and went deeper during the month. So you have to execute your strategy flawlessly in environments like that for a monthly strategy. And here's this is 2020, a COVID crash, fell 21% from the beginning to the end of the month, but went deeper during the month. The pain just gets shifted, and you have to be able to have the same thought process as what you have right now when things are going well. If someone said to me, this is how the journey would look, I wouldn't have commenced. What kind of journey are we looking for as an active investor, as a trader, compared to being on the sidelines and being passive? What are our expectations? And you should write these down when you start your active investment journey, and then you should journal these as you go and as you learn, and particularly when you do the 4-week training intensive, then and see what your expectations were before you do the course and after you do the course. And once you've learned, once you've gained new knowledge, and then you step into the skills acquisition process, the actual doing, the experiencing of a series of events that teach you and train you to get skill, what your expectations are then. And they should change, because you should learn that we shouldn't have any expectation. And if you get to understand the material that's in James Clear's book, Atomic Habits, you understand how our minds innately work, how we are automatically wired to work, and how you've got to unwire that, and you've got to do some reframing and redefining of how you see the world, or how you see the trading world, how you see the environment in which you're operating in, to be able to become successful. You can't just be who you were, before you started trading and expect to be successful in the long term. You have to change who you are with respect to the environment in which you're operating. So what are your expectations? If you've done the training, if you've really done the training and you still have expectations, well, then I'll suggest to you haven't really got it yet. And you need to do it again, because you really shouldn't have any expectation, which is a projection into the future. That's what an expectation is. And to be successful in this caper, you can't have any projections into the future. Otherwise, what you start doing is trying to prove the future. So how do we prove the future before we even start trading? And how do we know they're going to be met? Whatever expectations you have. So this is where, trading in the zone is about breaking the nexus of the past, so disassociating with the past and not projecting into the future, i.e. having expectations. You have to get this material, otherwise you're going to be in a state of conflict for the rest of your trading life, which is just not a nice place to be. So why don't we solve that? Why don't we gain new knowledge and gain new skills so that it actually becomes an enjoyable process, because you understand how this whole caper works far better. And then you also get the skills, the mindset skills to match that. So it becomes a more enjoyable process. At any stage, even with excellent real life outcomes, how do we prove our expectations will continue to be met? Okay, let's look at that. Here's the first 5 years of the ASX public portfolio. Now, this is real money trading, right? So there it is from basically the beginning of January to the beginning of 2021. I've just used the 31st of December. And at this stage, we had done 136 trades, okay? But the performance is real money performance. We're smashing the index. We had way more than double the annualized return, sitting at 145% return on capital and a big juicy profit over there. Our exposure had been 86%, with a win rate of 46.32% and a payoff ratio of 3.06. Average winner, 3.06 times bigger than average loser, and an expectancy of 0.88. That's an edge. That is what an edge is, right? Did it win all the time? No, it didn't. It lost 53.7% of the time, right? That's part of the game. And the maximum drawdown had been 16% compared to the index being 36%. There's 136 trades, which is 27.2 trades a year. Now, I'm going to step back and show you some research as to what the researched edge was compared to what the actual achieved edge was in real money trading. But let's have a look at another real money SPA3 investor portfolio. This had been going for nearly 2 years and had completed 52 trades. At that stage, it was doing more than double in annualized returns compared to the market, the total return index or the accumulation index, 49% capital, and had exposure of around about 80%, a 59.62% win rate, and a payoff ratio of 2.37, an expectancy of over 1, which is just a brilliant expectancy. That just shows and that is obviously includes costs and everything, and it's real money, right? And a pretty good maximum drawdown of 10% compared to the market of 36%. That's an edge. That's going well, right? So at what stage do we, is this proving the future? Does it prove the future? Question I asked you. Someone said to me that this is how the journey would look. I wouldn't have commenced. So how do we prove before we start that our expectations will be met? Well, after nearly 2 years and then the public portfolio of 5 years, our expectations surely are being met. But how do those expectations that have been met of the past now prove that our expectations are going to be met in the future? So at any stage, even with excellent real life outcomes, how do we prove our expectations will continue to be met? Well, I can give you the answer right now. To not have any expectations. And that's what Mark Douglas asks of us to do. Otherwise, you're not in the now moment. You're not in the zone. Your mind's living in the future. And when we have poor experiences, we associate with the past. That's not in the zone. That's living in the past. So we don't trade in the future and the past. We trade in the now moment, in the zone. And that is what the 4-week trading intensive, and that is really what all of Mark's trading in the zone is about. It's about, and he talks about having a winning attitude. Right. So Marka is asking about those two portfolios. Can you show I will show you that in a moment. Some other comments by Bruce. So Bob saying my performance is 40% win rate, was 30% at one stage, and a P&L ratio of 1.39, not a winning combination. At the moment, it's not. Stick in, Bob. I'm going to give you the answers because you really, I'm taking a snapshot of what. And what is what you're telling me there, Bob? Prove what's going to happen in the future. So what we are doing is we are taking the past experience, we are now associating with that past experience, and we are projecting into the future of what's going to happen, what our expectation is. So we know what's going to happen based on what's just happened. Well, let's continue the presentation. But that's just me. Is that you? Well, Bob's just told me that is him, right? And this is the difficulty, and I'm going to answer this question when we get to the how do you trade properly? The exact question that Bob's put over there that others are feeling. And I've just, Vince has just said that Bob just started in November 2022, which has obviously been, that's the market environment that we're in. So now what people do is they take their experience, as I'm saying over here, now we've got live somebody telling us, and I've had countless discussions that looked at portfolios, looked at the statistics, had the discussions that I know people feel this. And this is the problem we've got to solve. So Bob is now looking at a performance from November, December 2022 to now, and then Bob is saying and expecting and projecting into the future. He's proving the future. That's what's going to happen. So that is Bob, and I'm sure there's a lot of other people out there that will listen to this. So the degree to which you feel you need proof of the future is the degree to which your trading mindset still needs work. And the degree to which you are proving the future by looking at your past experience, your past portfolio experience, is the degree to which you still need work on your mindset. Now, I'm saying this to you right now, but that is not me that came up with that, invented it, if you like. That's Mark Douglas, and he did it through years of coaching. And I'm doing it through years of my own lived experience of what he coached me to do, and me of coaching other people, but also me seeing people and talking to people and seeing them face to face and discussing with them, in over Zoom meetings or whatever, and in coffee face to face, traveling around the country, that they went through that experience as well, and they've overcome it and they get it. So for those of you who don't yet have it, I'm telling you now that the answer is not analysis. But I will tell you what the answer is as well. And I'll prove to you it's not analysis. The answer is the 5 fundamental truths and the 7 principles of consistency. Because the 5 fundamental truths, what part of any one of them says you've got to prove the future by your past experience? Does anything can happen tell you that? Does you do not need to know what will happen next in order to make money? Oh, that's telling you exactly that you don't need to know what's going to happen next in order to make money. An edge is nothing more than an indication of a higher probability of one thing happening over another. We'll talk a bit about that in a moment. And there's a random distribution between wins and losses for any given set of variables that define an edge. Is there anything in any of those 4 that are telling you that you need to prove the future or that you can improve No, it's telling you that you can't prove the future. And what about every moment in the market is unique? Well, if this moment's unique and the next moment's unique and every moment going to the future is unique, how can you prove something that's unique? It's going to be unique. It's going to be different. How can you prove that? But people are looking for proof all the time. So how to prove? I'm now going to tell you that I can prove the future. Let's go ahead and prove the future. We're going to do this. So what I did is I went back, and I assume it's 2016, and I did a whole bunch of simulations, right? So here we are, 2016, about to start the public portfolio with real money, and I'm going to do a whole bunch of simulations on this edge called SPA3 Investor. So I looked at 16 years of data, and I used the original SPA3 parameters, the ones that we first released, and we took 21 stocks, basically the original, I think 14 plus another 7 that we released in the beginning of 2017. And I did simulations on those. Sure, it's a little bit out of kilter because we're doing the simulation on 7 stocks that we didn't have in 2016. But, to prove the point, because part of where I'm going to go to with this did include those stocks. So I've used the whole universe at that time of 21 stocks. Started with 5 positions with no BAPs. Also ran simulation of 7 positions with no BAPs, and also did 9 positions with no BAPs. Why did I do that? Because the public portfolio initially started when we only had a universe of 14 stocks. We started with 5 positions, and we grew to 7, and then we grew to 9 where it is now. But I also, which isn't really relevant, but just while I was doing the research, I did a bunch of other research, and I won't have time to go through all of it. But this really is the essence of the outcome of that research. Is that I also did with 9 positions with BAPs, even though we only introduced BAPs into the portfolio in 2020, and we're sitting in 2016 now. So I did that anyway, and I'll show you the outcome of that. So what happened here? So this is 5 positions from 2000 to end of 2015. And I'm not going to go through all of this here. I'll let you do it in your own time. I'll give you, to make the point, I'll just give you, some major points that we've noted over here. And you can see that there's an edge there, right? There's undoubtedly an edge. Expectancy 0.76 means there's an edge. Sharp ratio 1.24, there's an edge. and the rest is there. But the biggest growth year was 2004, which is a 38.55% return when the market did a 27.91. Sorry, yeah. The worst growth year was 2008, where the portfolio was minus 9.64 compared to the market of minus 38.36. Average trades per year, 17.06. There it is over there, 273 trades in total. You can see how many trades were done each year. Now, that is a function of only having 5 open positions, which will tend to make it lower. This is an edge. That's what we're doing in research. So we go, great, we've got an edge. I'm going to go and trade this live now, which is what we started doing in 2016. Now, I also ran with 7 positions. There's no BAPS here, and there's no filter, no stock filter. And what we found here, sure, there's still an edge, expectancy slightly better, 0.85, sharp ratio, slightly better, 1.38, and we did more trades. But the biggest growth year was 47.63%, which is 2009. And you'll see a bit of a pattern coming out here. And the worst was 0.02% in 2011, when the market did 10.54, minus 10.54. But if you just scan your eye, and you can do this in your own time, along the top here, you'll see that there's a big range of annual returns. Why? Because any system is dependent on what the market's doing. You can't pull 30% returns out of a minus 10% market, and vice versa. The average, vice versa, you can do. You can certainly pull minus 10% out of a 37% plus market. Lots of people do that all the time. The average trades per year is at 21.44, slightly higher because 7 positions that we had. Right, let's go to 9 positions with no BAPS and original parameters. And here we have the highest is a 51.57 in 2009. So what's a bit of a pattern you're seeing here is that the best returns come after big falls in the market. Now, what is one of the biggest mistakes that people make, whether they trade mechanically or not, is when the exit signals start arriving at the bottom of a market that's had a big fall, people don't take them. Why? Because they don't trust. They don't trust the system. They don't trust themselves. They don't trust the market. So the signals happen and people sit on their hands. And there's plenty of examples of well-known commentators that you heard me say that were in the press back in 2020, who are on TV and radio every other day, but they said that they were not going to get into the market again until the end of 2020. And we had this massive run-up. Now, they're not mechanical, but they got an excuse because they're subjective, so they're always right. But as a mechanical trader, a mechanical active investor, when those signals happen at the bottom of a big market, that's when you have to trust the most, because that's where you get your biggest returns. And that's what happened here in 2009. Big worst growth year, minus 2.51, an average of 27.13 returns trades per year, because we had 9 open positions. Now, I ran with BAPS as well. Now, I only putting up this slide to show you, because a lot of people have a negative connotation about BAPS. This is the original parameters, is that these green boxes over here show where BAPS were actually better. So better expectancy, better sharp ratio, which are the 2 main measurements, if you like, of measuring one system to another or one variation of a system to another. It has to be mechanical, of course. Exposure better, portfolio risk reward better, number of trades higher, 29.81, and win rate a bit lower, but with a higher payoff ratio, which gives you a higher expectancy. Expectancy is a combination of those 2 over there. So over that time, it is actually better, but we didn't start using them until 2020. We did get a higher growth rate, got a 61.53 in 2009, showing that BAPS actually work well in those environments, and you get a slightly higher exposure, but you're getting it in the lower price. Worst growth year was worse than the others, a minus 5.33. Average trades up. So let's just summarize this quickly. Simulated portfolios with historical data, and that's what they are. It's with historical data. The biggest growth year, excluding the BAPS, because we weren't trading BAPS until 2020, is 51.57. The next biggest growth year is 47.6, 39.39. Worst, minus 9.64. And trades range from per annum, right, a whole year, 12 trades to 41 trades, depending on what the market's doing, with an average of around 27. This is an edge. Let's go and trade it. So we went and traded it live. In 2016, we had 5 open positions, total of 13 trades in the public portfolio. Excuse me, we've got nearly double what the market achieved in that year. 2017, we moved from 5 to 7 when we introduced the 7 additional stocks near the beginning of the year. Got slight outperformance there. And then 2018 came in. We had 7 open positions there. And we did -10 compared to the market of -2.82. Maximum drawdown was worse than the market, 42 trades. Now, a couple of things here. We've got a worse annual return than what we got out of the entire research period. And we did more trades in that year than what we had done out of the entire research period. So the unexpected has happened to the downside. And then 2019 happens. So this is the 1 year public portfolio, real money, having done all that research. We've looked at what the performance is simulated performance. And now this is real money performance. And we did a 61.08% return. This is with no BAPs. So we did a return in 1 calendar year that exceeded all the research that had been done up to that time. What is that? The unexpected happened to the upside. So have we proved the future? Well, all that research that we did over those 16 years did not prove the future. What it did show is that we could actually do better than what we would, if we were trying to prove the future through all that research, we could actually have done better. And in the year before, we did worse than what the research had shown us when we were trying to prove the future. So we did smash the market, and there were 6 other years where there had been a 20% plus growth in the market. And that some of them we had done a little bit better than the market, and some we had done a little bit worse than the market when the market did those plus 20% returns in a year. And that's what the equity curve looked like. And in fact, that 61% had a little bit of on the 31st of December, was after a little bit of a dip. So proving the future. Now let's look at another real money portfolio. Sorry. This is that particular portfolio in 2000, and let's just look at the other stuff. 87% exposure, 56% win rate, which means we had a 44% losing rate. Payoff ratio nearly 3 times bigger per the average profit trade per loss trade, an expectancy of 1.21. When you get an edge like that, which includes losing, you are going to make money. There's no doubt. 23 positions and very low drawdown in the year. Now, that was the public portfolio, but it so happens we have some other social proof here where one of our members, Rob Meikle, posted in March of 2021, top right-hand corner, that in that year, he got a 57.86% return. And there are his results which he posted all on his own on the forum. Other people are getting these results. And what Rob would obviously have done is he had to, even after that -7% return over there, he continued to execute and trust his system and his process. So what have I done? I've disproved the future, right? And to the upside. So when we are sitting at any given time and we're looking at what's happened in the past, and it's all woe is me, doom and gloom, the sky, henny penny, the sky's going to fall on my head. What have we proved? Have we proved that it's going to continue being like that? Well, the point is we can't prove anything because we don't know what's going to happen, and nor do we need to know what's going to happen in order to make money in the market. An edge is nothing more than an indication of a higher probability of one thing happening over another. Can we prove our notions of future performance of SPA3 investor portfolios? Bob, I ask you, can you prove your notion that you're sitting there with right now of the future? You can't, but we do it all the time. Why? Because as James Clear tells us in Atomic Habits, that is how we are innately programmed. We are programmed to predict a reward into the future. And if we can't predict that, then we are not going to create habits that are conducive with the environment in which we're operating in. So we will go and we'll become cynical. We'll go and focus on the negative things. We'll start distrusting. We'll start hesitating. We'll start being disappointed. And that environment, that mindset, is what takes you out of the opportunity flow. You can learn a lot more about that by doing the 4-week training intensive. Can any portfolio be proven into the future? The two I showed you earlier, both the public portfolio and the other real money portfolio, where they'd done so well in the first 5 years and had also done well in nearly 2 years, where it was smashing everything. All the statistics were right up there. Did that prove the future? That was a mechanical. If you might have a subjective portfolio that you trade that is doing well now, does that prove it's going to do that into the future? Does any managed fund that's done well in the past prove that it's going to do well in the future? Is that what you do? People used to go through the newspaper and look at the 1-3-5-year returns of managed funds. And then they go, oh, look at these 3. I know, I used to do it back in the late 80s and early 90s when I started this caper, right? oh, I think I'll switch from that fund to that fund because that one's done better. When you look at the SPIVA report, SPIVA scorecard and persistent report, what you see is the ones that are in the top quartile all move to the bottom quartile for the next 5 years. In fact, all that research, go and look up SPIVA, go and look at the funds, and you'll see that they do not persist. Performance does not persist, right? So there are going to be periods where they do not persist. So how do we can't prove the future, but you have to get an edge. So and I'll talk a bit about the edge in a moment and how you need to trust your edge and how you grow to. An edge is nothing more than an indication of a higher probability of one thing happening over another. Fundamental truth number 3. Why isn't an edge a guarantee? Why isn't it an agreement, a contract, a covenant, a promise, an oath? Is that what you're looking for? Is that what you expect from an edge? That it's a promise, it's an oath that this is what's going to happen in all market conditions forever? Well, and I'll give you the paradox right at the end of this presentation about trusting. Is the Performance Forum thread looking for these? And with respect to all those people that are posted there, that is really subliminally, subconsciously what you're looking for. You're looking to prove the future. You're looking for a guarantee. You're looking for an oath that this edge is going to do that in all market conditions forever. And when it doesn't, I'm out here. I'm out of the flow. What am I going to do? How am I going to get into the flow? What am I going to use to get into the flow of this endless stream of opportunities that the market presents? I'm going to go to another edge and then another edge and another edge. Well, they're all edges too. They're not certainties. They're not 100% dead certs. They're going to present you with the same problems or different problems in different market conditions. But you're still going to be presented with those problems which you have to solve, of disappointment, of not meeting expectations, of conflict. Is that the way you want to engage this environment? Continuously with that mindset? Or you prefer to have a different mindset? Because that mindset is solvable. The analysis problem is not solvable. You'll never be able to analyze away those feelings. It just will not happen. I'll talk a bit more about that in a moment. Why isn't an edge proof of the future? Because the future will always be unexpected to the downside and the upside. You can't prove the future. Trading in the Zone, page 153. Sorry, I meant to put the page of the hard copy in here, but I won't be able to do it now. I won't be able to look it up. If you really believe in an uncertain outcome, then you will also have to expect that virtually anything can happen. So anything can happen means that when you've got 5 years of smashing home runs and you've got statistics that are blowing the roof off, you still got to believe anything can happen. And when you've got a period of 2, 3, 4 years where and it wouldn't have been, as I showed you the equity curve earlier, it's unlikely you're going to get 4 years where it's just all bad results, all negative edge. You still have to believe anything can happen because you haven't proven anything. You haven't proved that the future is going to continue like that. You can't. That is why you can't project into the future. That's why you can't associate with the past. That's why you have to execute in the now moment. But what do you execute? You have to execute something. You have to execute some kind of edge. Is that edge your intuition? Is it your subjectivity? Is it your subjective analysis? Is it taking into consideration external opinions and views and commentators' noise? Well, you have to define that. You have to answer that question. If you can't answer those questions and you haven't got a way of moving to being unflappable and peaceful, then you're just not going to enjoy the game. You're either going to, and it's not a case of going from football to basketball. It's not a case of going from this edge to that edge, because all you're doing is shifting the problems that you're going to encounter. How do you solve the problems? You're not going to be able to analyze away the problems with a different edge, a different system, a different approach. They're always going to be there, or they're going to be different problems until you think differently about this caper. Otherwise, the moment you let your mind hold on to the notion that I know that another edge is going to be better, I'll shift to that edge. I know that commentator is the guru. He's going to provide me with better analysis. Whatever it is, you stop taking all the unknown variables into consideration. And those unknown variables can have a massively positive effect as well as a negative effect, depending on where you're sitting at this particular time. You don't know that. It could go in either direction. Anything can happen good, anything can happen bad. However you define good and bad, which you have to reframe, by the way. Your mind won't let you have it both ways. If you have a notion that's projected into the future as an expectation, your mind won't let you have both ways. You're going to hang on to that. And James Clear tells us that we've got to undo that to build new habits. If you believe you know something, the moment is no longer unique. Fundamental truth number 5, every moment in the market is unique. If you now know, because of what and Bob's telling us is what's happened in the last year, is now going to happen into the future, well, then the future is no longer unique because you know what's going to happen. And the moment you know what's going to happen, it becomes known to you and knowable, well, now you know what's going to happen. Well, then there's nothing to know because you can prove it. You've got it. You've got this game taped. You've proven the future by what's happened in the past, good or bad, or positive or negative. So therefore, the moment isn't unique. The moment isn't unique, then it's provable. I hope you're getting to understand how important the 5 fundamental truths are, because those truths just totally throw out of the water the way that the discussion on the thread has gone for so long. And sorry, I'm picking on that thread, but we've had threads like that for many years. We've been purporting mechanical since 1998, seen it on the forums, talking to people, telephone, face-to-face, seeing their portfolios. That is not the solution. Hopefully I'm here, there's some logic in here that you're grasping on that proves to you how not to go about it, because I'm going to talk to you in a moment about how to go about it. I'll just quickly go through these some sparse investor characteristics that came out of the research. Trend following systems will struggle in wide-ranging sideways to down markets. Reversion to mean systems will struggle in rising markets, strongly rising markets. The worst market for a reversion to mean system is a strongly rising bull market. The next worst for a reversion to the mean is a strongly falling market. Those are the two markets that trend following do the best in. They take you out of the strongly falling market and they keep you in the strongly rising market. It's the sideways markets. So all you do is if you go to reversion to mean, you just shift the problem. You're still going to have negative, out of sync to the market when certain conditions occur. You get more open positions. The more open positions you have, the more manual trades you'd have. That's basically any strategy. More trades in down years, less in up years. Best periods are after big market declines. Investors find this the most difficult time to act, which is what I said. So when the market's had a 38% or a 50% fall and it starts rising, people don't believe, they don't trust those signals, and they don't take them. And then they forego, opportunity flow in the market. Right, so now I'm going to get on to how to trade properly. And I know it's taken a while to get here, but this really is, so bear with me, this really is important stuff. And I'm not just going to be going over what I've done in the 4-week training intensive, what Dave and I did. We're going to look at this from slightly different material that's not in Mark's book, and we're going to talk about how to trade properly. Okay, right. And some other things that are going over here. Just answered Bob, and Bob is now saying, it is okay, but not with 40% winning trades. Gary talks of win-loss of 3, around about 3. Now, I just showed you win-loss of 3. Bob, with respect, it would be naive to think you're going to have a win-loss ratio or a payoff ratio of 3 all the time in all markets in any sample of trades you look at. It really is naive because the market is a moving thing. The 5 fundamental truths tell us that, right? So for you to have an expectation into the future that you're always, all the time, going to have a win-loss ratio or a payoff ratio of 3 really is what Mark Douglas's book is all about. Sometimes that'll drop, as I showed you with those other real money portfolios that person has, they're below 1. Now, it's quite conceivable in trading in certain conditions for over a small sample that's going to happen. Like a casino, which is the house, can have a string of 10, 20, 30, 40, 50 losing spins of a wheel. It doesn't give up because it knows it's got an edge over a large sample. So to expect to have a payoff ratio of 3 all the time in all market conditions is really what you have to get to overcome. And I'm going to talk about that in this session over here. And Don is saying probably none of the forum discussion would not have occurred if the performance of the Australian sparse investor portfolios hadn't been significantly underperforming the market in the last few years. Absolutely, Don. Absolutely correct. And so that's reality. But what I tried to do there was take you through 5 years, the first 5 years, and say to you, and just go through that and say, well, that doesn't necessarily project what the next 5 years are going to be. We don't know because the market conditions play a role. We don't know what's going to happen, nor do we need to know what's going to happen. There will be times where one strategy will outperform another strategy in those market conditions. So what are you going to do? Keep swapping and changing strategies? What we do say is that we should have a core and satellites. And the combination of the core and satellites is there to address those risks, right? And the problem is that in a certain, if we've got satellites, 1 or 2 or 3 satellites, or once, and we've got a core, is that there are going to be times when your core is going to outperform your 1 or 2 or 3 or all of your satellites, and vice versa. But over a large sample, you want the sum of your satellites to outperform your core. Otherwise, they should all become core. I mean, that's really how we, as part of the risk management that you do as an investor. But and then Don is saying it's quite a different environment with the US portfolios, and it is what it is. And what we're doing now is we're looking at the past, and we are associating the past to now project into the future, that we know what's going to happen because of what's happened into the future. We know what's going to happen because of what's happened in the past. And the whole crux of Mark Douglas's material, is that you shouldn't do that, because trading in the zone is about now, and about executing now. You need to have some edge, whatever that edge is. And what I'm putting to you, what Mark puts to you, is that the best edge that he knew of to be able to get people to get the right mindset is a mechanical edge, not an intuitive edge or a subjective or noise-based or ambiguous edge, right? And again, that material's all there, so I don't need to go through it now. It's in the 4-week training intensive, and it's in Mark's book. And this is the crux of what we have to get. Otherwise, we're going to continue to be in a state of turmoil and conflict for the rest of our trading lives, until we get to understand what unflappable and peaceful trading really is. And that is how to trade properly. So I'll get into the material. Okay, so you back the one system for all market conditions. Well, no, I'm not saying that, Andy. What I'm saying is that you can have multiple satellites. So the idea is not to chop and change systems. And we've been saying for 25, 28 years, is that the way you diversify is not across asset classes, although you can do that to some degree, but true diversification is across strategies. But you don't chop and change and stop trading strategies, because you don't know when they're going to come to the fore. We can't predict and turn on a strategy when we think under what conditions, unless the conditions are mechanical, right? And what we're trying to do is solve mental issues that we have, mental conflicts we have, by analysis. And let me continue, because you really cannot do that. So here, and I've picked on analysis here. There's a lot of this material in Mark's, and I'm going to his Path to Consistency workshop, and I'm picking on, he actually goes into a number of points there, but I'm really, because of time, picked on one, right? And the one survey question he put there put forward is, making money as a trader is primarily a function of analysis. And he says the answer that is consistent with a trader's mindset is to disagree that making money is primarily a function of analysis. And he says it's natural to think that the more you learn about the markets, the better the trader you will be. There is some truth in this, but only after you've acquired all the appropriate mental skills. So all this discussion we're having here about performance and about the past, present, and future is about analysis. That's effectively what it comes down to, because what people are saying is analysis is the only thing that will determine my results. No, it isn't, because if you stop trading your analysis, then you're not going to get any results, good or bad, right? So if analysis is the whole thing, then this is solvable. You'll be able to solve all of the mental issues, the mental conflict and turmoil that you feel by analysis. And the only way you're going to do that, which we'll get into in a moment, let me give the answer there. Okay, so the more you learn about the markets, the better your trader you'll be, because that's how you interpret what the market is communicating. So we use analysis to interpret what the market's saying to us in terms of price action, right? But only after you've acquired all of the appropriate mental skills. Because here's what will happen, is until you have the right mental skills, you are not going to trust the interpretation of what the market's communicating to you, whether you use a mechanical system or whether you use your own subjective analysis, which you basically make up on the go as you're chopping and changing a tool set, if you like, of what to use when you want to use it, based on noise, what's happening in the market, what you're thinking internally, all that sort of stuff. And you'll chop and change on the fly out of your tool set what analysis to use in the market. So why do you do that? Because the first interpretation you get, you don't trust. So you change it until you get an interpretation of whatever analysis tool set that you have to meet your expectation or notion, either to not do a trade or to do a different one or whatever. Okay. And what I'm putting to you is that you can't, the reason you do that is not because of the analysis, it's because of the mental skills, what you're trying to avoid in the market. So the whole crux of his book is that your analysis will only work once you have the right mindset skills. No matter how good your analysis or market interpretation is, that's your analysis, you keep going, it will repeatedly result in bouts of emotional pain and disappointment. You cannot avoid that. And the degree to which you try and avoid that is the degree to which you'll be inconsistent, irrational, hesitate, and be inconsistent and get inconsistent results. And you simply will not apply it as it should be applied. You'll apply it until you get a set of market conditions that go beyond your threshold of pain. And then you will chop and change. And that is really what the essence of what looking back at what was on the performance forum and discussions we've had for so long. Eventually a set of conditions will come along that you will feel pain and disappointment. So how do you solve that? You take yourself out of the game? Do you change to another system? What do you do? Because it's an infinite game. You've got to keep playing this game. You can become a spectator, but all that does, because you've got to invest, or maybe you stop investing altogether. Well, how do you do that? Put all your money in the bank and just get draw down forever because interest rates are going to be lower than inflation? You have to solve this problem. And the problem of trying to use analysis to solve it is that the problem is always going to rear their head again until you think differently about how you feel about this. Okay, you've acquired all of so you simply will not apply, no matter how good your analysis is, until you've acquired all the appropriate mental skills. And that's what Mark's telling us. So we have to get the mental skills first. But how do you get the mental skills is what he is saying, is that you got to use a mechanical system to change the way that you think, to rewire how you think, to redefine, to reframe how you think about the markets. That's the only way you're going to get the peace, and you're going to overcome the automatic pain avoidance mechanisms. I know that people who've traded and have felt that know that they don't want to feel that again. But what I'm saying to you, the solution is to not to chop and change analysis, because all analysis is going to, by definition, have losing, missing out, being wrong, all the different things, drawdown, being in sync with the market, being out of all of those things, all of those conflicts, all of those uncertainties are always going to be there. You're never going to get rid of them by analysis until you reframe what uncertainty is. And that is why Mark's in his book, he's got a section called the uncertainty principle and how you can overcome that. But you don't overcome it by analysis. You overcome it by how you think about the environment in which you're operating. Meaning you'll forever remain on the quest of the analysis holy grail to try to solve your problems of psychological pain and disappointment. That quest for the holy grail of analysis will continue forever. You will never get rid of those pains. There's always going to be environments that are going to cause that pain and disappointment unless you think differently about it. You'll never be able to analyze away this repeating pain that results from the four primary fears that Mark talks about, which really involve all the stuff that's discussed on the forum. Periods of negative edge, periods of underperformance, but at the same time, there are also periods of outperformance and periods of really positive edge, as I've shown you. But when we have the notion and the feelings, the emotions of pain overpower the analytical, the fact, if you like I showed you there, that the notions that Nick had, favored. He had a blind eye to the ones that were really bad, but he had this notion about the ones that were better, and he wanted to get them out of his life. But he's continuing with the ones that are worse. That's irrational. Why? Because it's emotional. Okay, so you'll never be able to analyze away that repeating pain from analysis. Let's keep going. So there are three broad categories of skills you need to acquire to achieve consistent results as a trader. Analysis, being able to objectively identify an edge. So you need good analysis to create an edge with rules and boundaries. But what you don't do is you chop and change your analysis while you're on the journey, because that's what makes you inconsistent. And that's really what Mark talks about when he says you need to be a mechanical trader. That's the stage on which you actually get the mental skills, and that's covered in detail in the 4-week training intensive. You need execution. So you need analysis, you need to execute. That's being able to do exactly what you need to do without fear, hesitation, or any negative encumbrances. And then that's execute flawlessly, which Mark talks about in Trading in the Zone. And remember, it's an infinite game and it's ongoing. So you have to accumulate. So you have to allow your account balance to grow without the potential for self-sabotage along the way. And self-sabotage is conflicting beliefs. It's noise. It's getting subjective. It's taking yourself out of the flow. You're not going to be able to accumulate if you're not in the game, right? And it's an infinite game. It's ongoing. Analysis is the easiest part of the process to learn. And as a result, most people mistakenly assume that trading is also easy. So what you got to do here to be able to execute flawlessly and then to continue executing flawlessly without self-sabotaging yourself, well, out of those two, analysis is easier to do. But we have to accept our analysis. We have to trust our analysis at a level that allows us to execute flawlessly and to continue accumulating without self-sabotaging ourselves. But we make it very, very hard to do, much harder than what it is. Why? Because we keep on trying to make it perfect, and it'll never be perfect. To meet our expectations. What are our expectations? To project in the future that we won't feel pain, because that is what we are hardwired to do, to avoid pain. And until we can overcome this hard wiring of automatically trying to avoid the pain, we will continue to feel it. And because you will not do that by analysis, you'll only do it by changing the way that you think. It's an innate desire, as James Clear tells us, to predict into the future a reward, to be right. And the degree to which we are not right is, while we have that thinking, which is an unskilled trader's mindset, is the degree to which we're going to feel pain and the degree to which we're going to try and avoid it. And how are we going to try and avoid it? By analysis, by a new system, by stopping, by whatever. That does not solve the problem. All you do is shift the problem. You think you're solving it, and you do temporarily until it raises its ugly head again. So we chop and change our analysis. The problem here is, okay, so analysis and trading are not the same thing. No matter what your analysis says, the only way you can transform that analysis into profits is if you execute your trades properly. Trading is a function of proper execution, not proper analysis, if you like, perfect analysis. It's a function of how you execute your analysis. And that means staying in the game, executing an edge, having an edge. Now, this is all taken from Mark's Path to Consistency workshop. And I'm only addressing, one of the questions, which is the analysis one. Why am I doing that? Because it is the crux of trading properly, is to not go to analysis and chop and change all the time to do it. So how do we trade properly? You've got to execute our trades properly under all circumstances. Otherwise, we must know what's going to happen. So if we don't trade our edge, if you like, we don't trade our analysis as it is, as imperfect as it is. Well, at the moment we don't. We must be not taking that trade or changing the position size or going to trying to find a different edge, because we think we know what's going to happen, either with the new edge or in that particular trade. And that just leads to inconsistency. Why? Because we don't trust the edge that we have. To execute your trades properly, you need a strong sense of confidence, meaning a distinct lack of fear. Understanding the markets, which is analysis, understanding the markets, will not give you the sense of confidence if you haven't learned how to think in probabilities first. So let's go. I'm just going to reverse this now. So to learn to think in probabilities, we have to, and there's 3 question marks there, which I'm going to address, which Mark doesn't cover here, but he covers in Trading in the Zone, and we'll get onto that in a moment. And these 3 things lead to confidence or lack of fear. So you can't be confident and fearful at the same time. And that leads to trading properly. I've just reversed what he said in that sentence. So we've got to first of all think in probabilities, which leads to, I'll tell you what it is now, trust, which leads to confidence. And there's 3 different trusts that I'll talk about in a moment, and which is lack of fear, and then it leads to trading properly. So analysis alone, by better understanding the market and stocks, will never lead to trading properly. There's no analysis in there. And what people try to do is go to their analysis to get their confidence. The problem with that is that your analysis is always going to be wrong enough to never feel confident. There will always be times when your analysis, which is the base of your edge, is always going to have times when it's going to be wrong enough to take you past the threshold of not being confident, not trusting, which is going to allow fear to come in. It's going to then hesitate. You're then going to hesitate, and you're not going to execute flawlessly. You're not going to trade properly. And trading properly also means that you have a sense of peace, that you're unflappable, that you're not allowing all the noise to come in, that you don't have this mindset of conflict and disappointment when the analysis isn't perfect. And you say, I don't expect that, but you do innately. And James Clear's book tells us that we are hardwired to predict a reward into the future. And when we don't get a reward into the future, we don't like that. And then we go and try and change a habit. And we'll never get any habits instilled if we are operating under what James Clear is saying, trying to predict a reward into the future. Not predict, at something we don't like. We're always predicting. And that's sure that might work in other environments, but with trading, it does not work. And we are not going to go, you're not going to be able to go to our analysis barrel tool set to be able to solve that problem, because it can't be perfect. By definition, an edge is not perfection. It has losses and everything built into it. So it's actually saying to you that we're going to lose, that we're going to be out of sync with the market. but yeah, that's what you have to trust. In fact, you will find just the opposite is true. If you haven't learned how to think in probabilities, the better the analyst you are, the less successful you will be as a trader. Wow. Why? Because the more you put into analysis, the more you think you know what will happen. And you hear people talk about, technical analysis doesn't work because you're trying to predict the future. No, you're not. Definitely not. All you're doing is is using it as a tool set. And Mark talks about it in the beginning of his book when he talks about technical analysis versus fundamental analysis. All you're doing is using it as a tool to construct an edge, using rules, unambiguous rules to construct an edge, not construct a perfection, not construct a guarantee, not construct an oath or a contract. You're constructing an indication, That's all you do. An edge is nothing more than an indication of one thing happening over another, not a guarantee. And the moment you think that you're such a shit-hot analyst is the moment that you're going to believe that from that analysis, you know what's going to happen. You're setting yourself up for failure. And this feeds into what James Clear discovered in Atomic Habits. And he talks about this, which I've just said to you. To execute your trades properly, you have to get to the point where you are completely comfortable operating in a state of not having to know what will happen next. You're going to do the exact opposite. So we don't go to our last year and see that we've got whatever it is, 34% and whatever the win rate was, 1.34. Sure, that's a negative edge in that environment. Why? Because the market, that's just what it is. If your edge is out of sync for a period of time, does that prove it's going to be out of sync forever? Hopefully what I've taken you through today proves the exact opposite. It does not do that. It does not prove anything. Because now what Bob's doing is he's operating in the state of knowing. He knows that because of this, what's happened in the last 11 months or so, 12 months is, or 14 or 15 months, whatever it is, because that means he knows what's going to happen into the future. This is what trading in the zone is about. Trading in the now moment is about disassociating with bad past experiences and not trying to project a reward all the time into the future. We are hardwired to do both. Look it up. Go into psychology books. You don't have to take Mark's word for it. You'll find it there. James Clear talks about it as well. So you've got to execute, not having, regardless. And you have to operate not having to know, regardless of our analysis of what happened yesterday, last week, last month, last quarter, last 4.7 years is what happened with Nick, last 10 years, last 25 years, even the last 100 years. Because if any of that proved what was going to happen into the future, well, then the moments aren't unique. We know what's going to happen. So you have to operate in a state of not having to know, regardless what's happened, regardless of the noise, regardless of our ego. You can look up some great psychology stuff. Are we operating out of our ego or are we operating out of our authentic self? What are either? But you do not want to be operating out of your ego, because your ego all the time will be trying to protect and prove to what the future is going to be, to protect yourself from the future. That's what it's there to do. So we have to overcome our ego when we trade. And noise is external. Now, noise is part of your analysis, because that's what you're taking all the time. It's giving you notions of what you're going to prove through your analysis. You got to take those notions, that noise, out of your head, and that's why you got to have a set of rules which define an edge, that also define and structure how you execute in this uncertain environment called the market. And to do that, you have to not know what's going to happen, regardless of whatever your system or whatever your past analysis or whatever your results are to date. Mark is saying, Gary, as a system designer, how do you decide when the edge needs to be redesigned or improved upon, as you have done in the past couple of years with BAPS, market sentiment indicators? That's a really, really good question. That doesn't mean, so the difference there is that you need to take some time out every now and then and see if you can't, with the new data that comes, the new historical data, if you like, that gets added to the data set, to reanalyze it to see if you can't improve your edge without curve fitting or anything like that, because you need to have the skills to do that. But what you don't do is do your analysis on the fly. That does not work, because that leads to inconsistency. So when we get a data set of data and we see how the edge operates in that, and it's got to be a decent set of data, not a few days or a few weeks, we analyze to see if we can't make some improvements. But I'll tell you, all my experience over the 28 years of doing the two, or we had three or in fact, there's been 4 main systems that we've provided to our customers, and we won't go into that now. But is that the changes have been minor. They haven't been throwing out the edge and starting from scratch. Why? Because the concepts and the principles behind the edge work, and there are always slight improvements you can make. But what you don't do is do analysis and which is also allowing noise to come in from the outside, which is external noise or your ego internal noise, to overrule and do its own analysis on the fly. That's what is inconsistent. And every time you do that, what you're trying to do is to predict the future so you can know. That's what we can't do. But every now and then, Marco, that has to be done. And that's what we did last year. But that's no guarantee that it's going to prove that the future is going to be better as a result of it. Now, we can show that it's, in fact, I won't go into that now. There's other research, and that's for another time. But I am comfortable. I'm not changing what I'm trading right now based on the research that I've done, even for the preparation of this portfolio, for this presentation, or the real money that I have in the market. I'm not changing it. I'm continuing to do it because I know the stuff I'm going to cover now is to why I've got to do that, why I've got to continue trading properly, and what trading properly actually is. So regardless of what's happened what's happened is in the markets equals markets, other stocks we own, and portfolio performance as well. So what will happen next? So it's we'll continue. Sorry, I could make some more points, and time is getting on. Right, let's keep going. When you've mastered the skill of being able to maintain your sense of confidence while simultaneously not having to know, so you've got to be confident to be able to execute properly, right? So which means you've got to have trust, and which comes from the thinking in probabilities, which is the 5 fundamental truths, right? You also simultaneously you're not having to know. You will be in the best state of mind to perceive what the market is making available from its perspective, and also execute your trades flawlessly, right? So if you're not confident and you're not operating from the state of not having to know, then you're not going to be in the best state of mind to perceive your edge, your entry signals, and to continue executing it. What you're going to be doing is second guessing. You're going to be hesitating. You're going to be making mistakes. And what are the mistakes you're going to be making? Why? Because you're trying to avoid this pain that you're projecting is going to happen in the future, because you know what's going to happen based on what's just happened, which you don't. But that's how your mind will continue to think unless you change how you think with respect to the market. So you'll never be able to execute your trades flawlessly. So execute flawlessly means playing an infinite game. That doesn't mean stopping and starting at your will with that particular edge. So if that edge doesn't work at that particular time and you don't execute it flawlessly, well, how are you going to have the skills to go and execute another edge, which is not certain, not a guarantee, not an oath, flawlessly in the environment of the market? Because at some stage, a set of circumstances are going to occur when that different edge or different edges are going to suffer the same thing. And then you're still going to be, through the way that you're thinking, the unskilled trader, going to be trying to find that projection into the future of being right, trying to prove the future. And you've got to execute flawlessly by your predefined rules. If you don't like those rules, well, you think you're going to get another set of rules, but those set of rules are still going to present you with the same psychological problems with confidence, right? And without hesitation and doubt. You've got to execute flawlessly with confidence and without hesitation or doubt. When you get to a point in your development, and I'll make the point over here that we are all imperfect, developing, changing, imperfect human beings on an ongoing trade. We will never achieve perfection in any walk of life. So we're always in a state of development, if you choose to be. Where you can execute trades flawlessly is when the full potential of your analytical abilities will come to bear on the bottom line results. So what Mike's saying over here is that get your mind right, and then you will be able to trade flawlessly, and your analytical abilities will come to the fore. So rather than questioning, hesitating, second guessing, you'll put yourself into the flow of the market rather than take your flow out of the market, fully trusting and understanding that your edge and you are imperfect, growing system and human beings. To accumulate money over time requires a distinct lack of potential for self-sabotage. Self-sabotage is the function of not completely believing what we deserve, that we deserve the money or success. Now, this whole area, I'm not going to go into it now. There's Carol Dweck does it in Growth Mindset, and a lot of other people talk about the sense of self-worth. But you will never get a sense of self-worth if you don't have the confidence in what you're doing. So all of the stuff being spoken about here of thinking and probabilities, from the 5 fundamental truths leading to trust, leading to confidence, leading to trading properly. If you don't feel that process you're going through, confidence in your edge and trusting it, you're not going to feel worthy of what it can produce. And then you're going to go and look for self-worth somewhere else. And where it really comes down to trust and confidence. I don't want to go too much into that, but it's far easier to self-sabotage a discretionary and a subjective process than it is to self-sabotage a mechanical process. at least in a mechanical process, you got a benchmark, you got a set of structure to work on and get better at. How do you improve, discretionary trading and subjective? By definition, it's always, if you stay in that way of that approach of doing things, you're always going to be changing stuff. So how, you think you're improving, whereas you could be going backwards. How do you know? Because you've got no benchmark against which to actually measure it. So there's no measurement in that environment to know that you're getting better or not. Whereas this is why Mark talks about having a mechanical system, because you can improve to the point of where you execute it properly and flawlessly to know that you're getting better, and you can actually measure your development, your state of development. And as Mark says, mechanical can train us to overcome self-sabotage. Right, getting to the end of this before we get into the finale, more of better analysis will not in any way compensate or neutralize the negative effects of these internal forces. So the point Mark's making here is that it's internal forces, not external, that negatively affect us as traders that we have to solve. So these internal forces, even if the force is identified like noise coming from external, it's the internal forces have to deal with that. And it's how we deal with that is what negatively affects us as traders. And that's what we have to solve. So we're having to solve us, not the market, because you can't solve the market 100%, nor can we probably solve ourselves 100%, but that's what we've got to work on to get better. So analysis on the fly exacerbates rather than solves this problem of better managing our internal forces. The bottom line is analysis is only one very small step in the process of becoming a consistently successful trader. So analysis, what Mark is telling us, is that analysis is done before you trade, and that analysis creates a set of unambiguous rules, rules by which we play the game, and that's defined as an edge. Whereas your analysis should not be done subjectively, for each entry. And then, if you think about it, if you're a subjective trader, you are doing analysis each and every day, every trade is open, trying to determine whether you should sell or not. And what people do is they don't apply the same stuff. So the reasons they get in from one trade to the next, and the reasons they get out from one trade to the next are different. So how do you measure that? You don't know. And so you'll continue chopping and changing your analysis subjectively, trying to solve what really are internal forces, internal problems, internal psychology, mental problems that need to be solved. So until, as Mark says, you solve those mental internal forces, you're never going to be able to trade properly, because you're always going to be trying to solve it with analysis, which is impossible. External noise is analysis as well. So how do you trade properly? Okay, I'm just trying to see this. That's not stuff that's on subject. Okay, right. So how do you trade properly? Well, first of all, you got to accept all the risks, all the pains of trading, every single one of them, right? With every part of who you are. And that's all in the 4-week training intensive. So I won't go into it now, and it's all over Mark's book as well. And then you have to achieve trading consistency through the 5 fundamental truths and the 7 principles of consistency, which I definitely will not go through now, because there's plenty of training material on that and all over Mark's book. But to start with, you must have an evidence-based edge, an edge that has sufficient evidence for you to trust in. So this is no different. Any business team, sporting team, individual, any walk of life needs to have an edge of some sort to be successful in whatever that walk of life is. And it can't be subjective or discretionary. Businesses don't put in systems and processes. They do it so they can repeat sameness. So it can be done. And they know that the repeating of that sameness leads to success. And along the way, any of those processes, they're getting measured. So they know that they're not perfect, but they lead to success. And how many processes and businesses do you know that people that are part of a process are allowed to just be intuitive along the way? Do you know of any? Even football teams, sometimes the good players are said, play what's in front of you, but they're still going according to a structure, to a game plan, a set of rules that the team has, and you can trade mechanically. So this is what Mark talks about, and what we are on about and have been for a long time, is that mechanical is the way to be able to have an evidence-based edge that you can trust and move forward with. So let's talk about accepting all the risks of trading. Quickly, the 4 primary fears that Mark talks as being wrong with entries, more losing trades than you expect. So losing, missing out on big winning trades that you just won't fit into your portfolio because you don't have enough money to trade the whole market. So you're going to miss out on some big winning trades while your portfolio is full. You're going to be exiting, you're going to exit trades that continue to rise. They're going to fall a little bit, take you out, and they're going to continue to rise and win some more, and you're not in it because you end up in some other trade. and that other trade that continues up, you're not in it at the time. So it's a degree of missing out as well. All of that's going to happen, right? Selection bias will occur in any subset of the market because you're going to select these and those are going and whatever. You're just not going to be able to cover it all. So this is selection bias is a part of missing out. Every edge will not play out exactly as in research, as I just showed you. You can't prove the future. No edge can, whether it's subjective, mechanical, or otherwise. Every edge won't be in sync with the market in all market conditions and all the time. It's just not going to happen, right? The fact that it's different means it's going to not be in sync all the time, in both the upside and the downside. Every edge will underperform for periods of time and outperform as well. Anything can happen. Every edge will have periods of loss rates between 75% and 35, i.e. win rates between 25% and 65%. Seldom, and in fact, we even had win rates, as I showed you earlier, 70% for a two-year period. So that's going to happen, right? Why? Because it's a dynamic, ever-changing environment. And every moment in the market is unique. It's not the same. That's just, now hopefully you can understand how important the 5 fundamental truths are. Trend following systems will get chopped in sideways markets. Reversion to mean systems will get chopped in rising and falling markets. That's just the risk. That is the risk of playing this game. You're not going to have perfection, or you're certainly not going to have, forget about perfection. I know you kind of accept it, even though, James Clear tells us that's what we're trying to get. We're trying to be right all the time, projected into the future. And that's what you have to overcome. And, the serenity of that, and really what that means is that we're trying to be right all the time. We're trying to achieve perfection, but we know at a rational level that it's not achievable, but our subconscious is trying to do it. You're going to get chopped. That's what's going to happen. These are all risks. Every single one of these have to be accepted with every part of who we are. Because if we don't, we're going to try and prove the future. We're going to associate with the past, and we're going to pick on, the painful stuff, and we're going to blow that out of all proportion. Tversky and Kahneman tell us, that the pain that we feel from losing is twice the pleasure we get from winning. We're hardwired that way. So we have to overcome that. Otherwise, we're going to self-sabotage ourselves in the market. Until you truly accept all the risks of trading, you'll perceive these risks, all those ones I mentioned, as threatening, as hurtful, and as mistakes, and as being painful. And you're going to automatically, as Mark Douglas tells us, and other psychology books tell us, as Jeff tells us, you're going to try and avoid them, and you're going to try and solve them through analysis, which cannot be done, as I'll show you in a moment. So you have to truly accept these risks. They're going to happen. Here's a fact. No better or more analysis will completely solve any of the risks, in not a single one of them, which are equal to the pains, the emotional pain that you feel that occur in the market. No more analysis will completely solve any of them. At some time in some market, your expectations will not be met, resulting in disappointment, despair, all the negative emotions, all the negative energy that comes from that. But then what do you try and do? I'm going to go and solve this. I'm going to go and do more analysis because I can't meet my expectations of projected into the future. Trading in the zone means now moment, not projecting into the future or associating with the past. So what do you do when that happens? Find another system, find better analysis. Sometime in some market, your expectations will not be met again with that new system, that new analysis, that new indicator, whatever it might be. You're not going to be able to analyze away, the pain that comes from not meeting those expectations. So what does Mark Douglas tell us? How to trade properly? Not to have expectations. Anything can happen. That means you don't have an expectation. I don't need to know what's going to happen in the future. I don't need to know in order to make money. I don't need to know what's going to happen next in order to make money. He tells us every moment in the market is unique. Well, if it's unique, how can you know what's going to happen? Just a bit of a sojourn over here. Roger Federer, he did a speech not so long ago, a 25-minute speech. Google it, Roger Federer at Dartmouth College, and you can listen to the whole thing. I'm just going to read a couple of things over here. Take me a minute or so, and just to really punt home that what we're doing in trading is really no different in other walks of life as well. You need an edge, and you need to be able to handle losing. In the 1,526 singles matches I played in my career, I won almost 80% of those matches. Now I have a question for you. What percentage of points do you think I won in those matches? Only 54%. In other words, even top ranked, not the average or the number 50 or something who do very well and make money out of it. Even the top ranked tennis players win barely more than half of the points they play. When you lose every second point on average, you learn not to dwell on every shot. Shot equals trade. You've heard me give golfing analogies. You teach yourself to think it's only a point. It's only a trade. Here's why I'm telling you this. And he goes on explaining the different points that he loses. When you're playing a point, it has to be the most important thing in the world, and it is. But when it's behind you, it's behind you. This mindset is really crucial because it frees you to fully commit to the next point and the next point after that with intensity, clarity, and focus. So when we're looking at the last 13, 14 months, we were okay. That live portfolio I showed you earlier was okay for the first 2 or 3 years when you got a 70% win rate and we're going gangbusters. And then we have a losing point or two for a period of time. If you're looking at that past all the time, you are not going to be able to execute into the future with intensity, clarity, and focus. The truth is, whatever game you play in life, sometimes you're going to lose, many more times than sometimes. A point, a match, a season, a job, a trade, a quarter, a year maybe. As we've shown you with the research, we had losing years. It's a roller coaster with many ups and downs. Oh, life is, tennis is it? Well, what about trading? And it's a natural part when you're down to doubt yourself. Natural. That's what we have to overcome. But negative energy is wasted energy. You want to become a master at overcoming hard moments. And this to me is a sign of a champion. It's not only the sign of a champion, it's a sign of just winning. The best in the world are not the best because they win every point. It's because they know they'll lose again and again and have learned how to deal with it. And that's a mindset. That is all the practice that he did and all the top players did. They still lose points, around about half. And the more practice they do, the more analysis they do, they're still going to lose half the points, which is what's going to happen. We can't project into the future and have an expectation all the time of what we will expect. You can't have an expectation. You have to learn how to deal with it. You accept it. Cry it out if you need to, then force a smile. Move on, be relentless, adapt and grow, work harder, work smarter. But what do you work smarter and harder at? What I'm putting to you, what Mark Douglas is putting to you, what James Clear's putting to you, what so many other psychologists out there, even in the training intensive, put down there. Jack Nicklaus, golf, 90% is mental, right? But you can go practice as much as you like. And even in the book that I wrote, and from Flustered to Unflappable, Venus Williams talks about it's in the mind. Otherwise, you're just good at hitting tennis balls, but you're not going to win matches if you don't change your mindset. You're not going to be a consistently successful trader if you don't change your mindset. So you work harder and smarter on how you think, not on an endless stream of trying to become the best analyst there is, because no matter how good an analyst you are, you're still going to experience the pain, the emotional pains that come along with the primary fears that Mark talks about, and the downs, the ups and downs, the downs of market downtimes, portfolio downtimes. You have to deal with those psychologically. So you have to achieve consistency, which is objectivity. You have to accept not knowing. You have to practice and repeat a mechanical edge. You have to have a winning mindset and a growth mindset. We've defined those in the 4-week training intensive. Growth mindset is Carol Dweck. Didn't go through that in the training intensive, but we have another course, which is a winning mindset, and we talk about that, and you have to have that mindset. In fact, Mark Douglas's book, I put it on my desk, the subtitle is about a winning attitude. You got to, just to take a TV advert at the moment, which says, you lose, you win some, lose more, which is gambling. Well, if you the casino, if you the house, if you got an edge, well, then you lose some and you win more. It's the opposite of that advert. Consistency is so inconvenient. It's much easier to be impulsive and subjective. I'll intuitively know when to buy when the market hits rock bottom. I'll intuitively know when to sell. My intuition, i.e. my ego, protecting and proving, is it knows better than a mechanical edge. We've seen people have posted on the forum, and I've spoken to people. We know that's not the case. Look for greener pastures. It's that edge over there is better. That grass over there is greener on the other side. Perhaps you've got to water your own grass to get it greener. It's easier to give into ego, bias, blame, criticism, cynicism, to focus on notions of negative energy, as Roger Federer just told us. No, that's not how you do it, because there's always going to be enough imperfection in anything you do to go and focus on and get critical and become a cynic about and to blame. Victimhood is not the way to solve this. There'll always be all of these will always be there to some degree because we're human. But we have to learn in the environment in which we're executing to overcome that. And Mark Douglas gives us all the tool sets to do that. All we have to do is understand it. So the prerequisite steps to consistency and confidence are the 3 trusts. So remember I said think in probabilities, which is basically the 5 fundamental truths, leads to 3 question marks, trusts. And Mark talks about that in his book, and I'll give you some quotes in a moment. which leads to confidence, which leads to trading properly. And these three trusts are, you've got to trust the market. With all its imperfections and ups and downs and losing periods, we've got to trust the market is an endless flow of opportunity. It's an endless stream of opportunity. We've got to trust our edge, your edge. You've got to trust yourself. I've got to trust myself. Those are the three trusts we have to have before we can get confident. So trust is the foundation to being confident in your relationship with the source of endless stream of opportunity. So you've got a relationship with the market. You have to trust in that source, that endless stream of opportunities. You have to trust and objectively and easily identify those opportunities with an edge. You have to stay in the flow. And then you have to flawlessly and peacefully execute them by trusting yourself. This is what you have to, otherwise you'll never get to confidence, a level of confidence to be able to execute and play this game successfully in an unflappable manner, peacefully, as an infinite game for the rest of your days. Some more quotes by Roger Federer, which he made last year. I believed in myself, but belief in yourself has to be earned. It doesn't just happen. How do you do that? You do that by gaining skills. You do that by executing a series of events where you reprogram yourself to get to a point where you believe in yourself with respect to what you're trying to do in the environment in which you're executing. But in tennis, like in life, discipline is a talent, and so is patience. Trusting yourself is a talent. Embracing the process. Many of you heard that before. Loving the process, enjoying the process is a talent. Now, that process involves all of those risks that we put down there. And I won't go through them now, but you know what they are, which you see as pains, or if unskilled trader sees as pains. Some people are born with them. Everybody has to work at them. And he tells you that he had to work at them. It was hard work. He did it. He got to a point where he believed in himself. He earned that belief in himself. And we have to do that as trading. If you think you're going to come along here and just start trading, chuck some money in an account and make money, sorry, it just will not happen. We have to do the work. How do you know? Okay, let's get to the crux of this. How do I know that my mechanical edge is not broken? And I hear this all the time. It's on the forum. How can you trade properly if in the back of your head all the time, you don't know whether your mechanical edge is broken or not? I don't. I can't give you that, because an edge is nothing more than an indication of a higher probability of one thing happening over another. It's not a guarantee. It's not an oath. It's not a contract. So you'll never know if it's not broken, but you will know through your measurement and how you feel that you're out of sync with the market, that you're going through a down period, like Roger Federer goes through downs and ups. You do it in all phases of life. Businesses go through it. Teams go through it. We go through it with all our relationships. So is your relationship broken because you're going through a down period? Is your business broken because you're going through a down period? So you'll never know for sure. So then the question is, how can I trust it if I don't know whether it's broken or not? By definition, an edge is untrustworthy. By pure definition. Why? Because it's not an oath. It's not a contract. It's not a guarantee. It's not an agreement. It's an indication. So it's untrustworthy. Why? Because it defines losing. If you've got an edge that wins 50% of the time, well, you're losing 50% of the time. It's in there. So how can you trust something that loses 50% of the time? It defines drawdown, even a maximum one when you do your research, and the research I did. It defines uncertainty because it's not perfect. It defines all the risks and the pains that we have to endure. They're all in there. So it's a dead cert. All of that's going to be felt. And if an edge can't be a contract, a perfect, an agreement, an oath, it can't be 100% winners. It's always going to have all of those defined in them. So when you go and look at, depends on what notion you want to prove. Do you want to prove that it's not going to work in the future? Well, you can do that. Why? Because there's enough ammo there to do it. You'll find it. If you want to find it, you'll find it. Why? Because it's not perfect. The imperfections will be there, as there will be in your relationships you have, in your businesses, everything else. If you want to look for the imperfections, you'll find them because they're there, because they're not perfect. Nothing's perfect. We are just growing imperfect human beings. So do you want to grow or do you want to stagnate? Do you want to have a fixed mindset or a growth mindset? How trustworthy is a non-mechanical approach that you have no idea whether there's an edge? Well, why do people trust those? You should ask yourself that question. The paradox of trading is that we have to trust in an edge that is unprovable by analysis as trustworthy. The paradox of trading is that we have to trust in an edge that is unprovable by analysis as trustworthy. So you have to trust something that's not trustworthy. Roger Federer had to do that. Everybody has to do that because no edge is perfect. The casino does it. But the discussions here today and on the forum are asking that every period, every time, every whatever, no drawdown, they're asking for perfection. And when there's no perfection and there's something that makes you feel uncomfortable, that causes conflict, well, then what I'll do is I'll find another edge because that'll solve all the problems. No, it won't. So you'll never be able to fully, by analysis anyway, define something as trustworthy. An edge, by definition, delivers all of the risks, every single one. in spades that we innately want to avoid. That is how human beings operate. So how do we do this? How do you actually do this? How do you do this at a functional level? We have to reframe all the risks that trading delivers. We have to redefine them. Mark Douglas tells us this. And how do we reframe? We don't just decide, well, I'm going to reframe all the risks. There we are, done. I'm going to be a skilled trader. I'm going to be mentally skilled from now on. No, you have to go through a series of events. You have to experience this. You have to do deep practice of this. And when you do that, according to Mark Douglas's 5 fundamental truths and his 7 principles of consistency, your mindset gets changed. I can say I've overcome that. I know I'm there. I know lots of customers that are there, but they had to do the work. Like Roger Federer had to earn his self-belief. You have to earn your self-belief as a trader too. And how do you do that? You've got to trust in the market. You've got to trust in your edge, as untrustworthy as you think it might be and as untrustworthy you think the market might be. And you've got to trust in yourself, as untrustworthy as you may think you are, with respect to the market. And that doesn't just happen. You have to go through a series of trades, of experiences, of practice to do that. And this is mental in nature. Cannot be done by analysis. You cannot analyze away. You cannot do it. And when I say analysis, continuing to analyze away. Somewhere along the line, you have to put a stake in the ground and say, that's my edge. Like a casino says, that's my edge. They've got rules they abide by. They can have so many losses in a row, but they keep executing. That is the mindset. And we cover that in detail in the 4-week training intensive. Mark Douglas talks about it in Trading in the Zone in some detail about getting the mindset of a casino, the house, not of the punter. This is mental in nature. It's not by analysis. And you've got to step into a mental skills acquisition process in inverted commas, because that's what Mark used to say. Step into a process to acquire the skills. If I don't do that, otherwise I can try to prove the future, which is why I took you through that exercise earlier. How do I do that? You do more and more analysis. So the question asked earlier was, who asked it was, well, why do I do that analysis? Well, I do it from time to time. But, if I continue doing that analysis, trying to achieve what my brain is innately programmed, hardwired to do, that analysis will never finish. It would never finish. So, which is why so many people who take on the task of creating a mechanical system, they never finish it, because they haven't yet got the mindset skills of understanding what Mark Douglas talks about, consistency. They continue to try and analyze away in their research all of the pain, the pain, the risks that cause them pain. And in that very process, they continue analyzing. They never get there. They never create their mechanical system. They never put a stake in the ground because their edge isn't perfect. And they don't, until they get the subconscious skills that are talked about that Mark Douglas talks about, and we talk about in the training intensive, they will continue to try and analyze away in their research the very things. That is the very nature of the question I got asked earlier. It's a quest for the holy grail of analysis that takes care of all the risks. That's what people are trying to do. They're trying to find the holy grail of analysis through analysis that removes all the risks. And then they'll say, I'll find peace and I'll find a system that suits me. Sorry, doesn't exist. Rather than embark on that quest, I'll continue working on improving my mindset to trade properly, according to the truths and principles discovered by Mark Douglas, with a positive winning attitude, not a negative energy that Roger Federer spoke about. What is a positive winning attitude? Mark Douglas, he defines it in chapter 3, page 36 of his book. I define a positive winning attitude as expecting a positive result from our efforts. That's all you can do. Not expect perfection, positive results over a large sample, over a large period of time, with an acceptance that whatever results you get are a perfect reflection of your level of development and what you need to learn to do better. That's what the great athletes have, a winning attitude that allows them to easily move beyond their mistakes and keep going, like Roger Federer just told us. Others get bogged down in negative self-criticism, regret, and self-pity. Not many people ever develop a positive winning attitude, but you can. You can. And you've got the material to learn how to do that with respect to trading. Here's the rub. There will always be enough uncertainty and negative outcomes to find logic to justify, to not trust our relationship with the market, with our edge, and with ourselves. Always be enough logic to justify looking for greener analysis pastures. Let's go and find some other grass to water rather than water our own grass or nurture our own grass. Not work on improving our trading mindset. We can go and work on getting better analysis to analyze away all those risks, to justify, to take a path of low resistance. So distraction. So it's easier, it's far easier because it doesn't take effort to get distracted, to be inconsistent, because you just willy-nilly go along until the pain gets too much, until you have to change because it's just too much to bear. This will take effort until we become unflappable. How to trade properly. Those traders who have confidence in their own trades, who trust themselves to do what needs to be done without hesitation, are the ones who will be successful. Traders have this is right in his preface, right in the very beginning of Trading in the Zone, who trust themselves. You will build a sense of self-trust. You must learn to trust your edge. All the tools of how to learn to trust your edge are in the 4-week training intensive and in Mark Douglas's book, Trading in the Zone. Questions even here today, the discussion on that particular forum thread, or the discussion on so many forum threads we've had over the years, all come to the crux of this. The 3 trusts: trust the market, trust your edge, trust yourself, leads to confidence, which means lack of fear, which leads to trading properly. That's where you get consistency from. What are the tools to do that? The 5 fundamental truths, the 7 principles of consistency. How do you train your mind to do that? Step into a process to experience those, to keep the journal. The skills acquisition program that we talk about, plan that we talk about in the training, do that. That's what you have to do. The defining characteristic that separates the consistent winners from everyone else is this: the winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all confident in spite of the adverse conditions that Bob has had over the last year or so, that Nick Rosetta had over 4.7 years. Well, it wasn't 4.7 years. It was only the latter end of it. But, for many years it was fine until it wasn't fine. Why? Because it went past his threshold of what he expected, which then led to disappointment. And that disappointment's now getting to go and do all the things. It's one of the risks of trading the market. He experienced it, he got disappointed. Why? Because his mindset is not skilled enough. And I suggest there'd be many people listening to this who'd be in the same boat, or degrees of, or elapsing for whatever reason. It's an infinite game. We have to continue working on it. Golfers have to continue practicing. Tennis players have to continue practicing and getting better with a growth mindset. Attaining this kind of mindset is easily achievable. It really is, compared to trying to find the analysis holy grail, which is impossible. You'll never get there with analysis, but you have a snowball's chance of getting the right kind of mindset, as Mark Douglas talks about, and as we went through in the training intensive, to be able to be very successful in this game of trading the market. It's not going to be by analysis, which is noise, which is chopping and changing systems all the time, which is chopping and changing the system you have, which is overriding your system because of you got better analysis. Throw in a 30-week moving average, do this, do that, because that's better. Because I know it's going to be better. You don't. You can't prove the future. You'll waste a lifetime of mental conflict and trial and error if you try and analyze away the risks of the market. So how do you do it? The 4-week process of mindset training intensive, studying Trading in the Zone by Mark Douglas, and study Atomic Habits by James Clear. Will that get you 100% there? We'll never get to 100%. But you have to try. You have to step into a process to do it. Otherwise, go right back to the beginning. Become a passive investor. Become a spectator. But all that does is shift the risks to risk number 1, not having enough, and risk number 2, sequence of returns risk. When the big 50 to 80% markets come, which they are going to happen in the next 2 to 10 years, and it might happen more than once, being a spectator and being a passive investor just won't work. It's been 2 hours. You might sense a little bit of frustration in me. I don't apologize for that. Hopefully my animation and really hitting the crux over here gets it through to you, because that's really what Nick said, is that we do want our customers to be successful. But we are not going to be able to provide you with an edge that you expect is going to solve the problems, because nobody will be able to do that. But what we can do is give you the training and give you a system of training, if you like. If you want to share well systems, it's not just systems in terms of mechanical systems, it's training systems as well, a skills acquisition plan to get you there, because you can solve the mindset problem. You can get the mindset, attain the mindset that Mark Douglas talks about. But and that helps you really accept all the risks in the market. You will never be able to solve all the risks in the market through analysis. Hopefully I've got my point through. Please watch this over and over again. Share it with other customers you may know. But this is really the crux of it. And there's nothing really more to add. You have the solution of how to get there. I'm going to finish up now. And there have been some questions and comments. I can't see any new ones for a while. So I think I have any more slides. No, that is the end. So we'll finish it there. Thank you for your time and attendance. And you can watch this in sections. But it really there's nothing really more to add to this and to what you can learn in the training intensive. So you are certainly welcome to. We'll post this. You'll obviously get a recording, but we'll also post this on the forum, where on the performance thread, and you can certainly ask questions there, and we can discuss things there as well. And if anything more needs a presentation or webinar to explain and go through, I'll certainly do that as well, because we really do have our customers' interests at heart, and we really do want you to get there. But we are not going to be able to solve it by having the best system, because there's no such thing as a best system. There's a best system for periods of time, and then it's not the best system, and then it is again, and then it isn't. But what we can do to help you solve the problem, perceived problems in the market, the risks that people battle with in the market, which are just part of the game, we can help you solve that through training. I wish you consistent, objective, and peaceful active investing.